Little changed out of Asia this morning at 96.78 after a bit of a leap yesterday, which saw quite a range. If you look at the intraday range of trading on Brent yesterday, it went as high as 99.50, having opened at 96 or so, a little above 96 yesterday. So it popped up clearly on the drama of all things Ukraine. And then, like everything else, it seemed yesterday that there was a pullback, a drawback, a kind of a, oh, well, the same old European Western appeasement response. This is just going to be a big Crimea, a big cry, Mia, and all will remain the same. I suppose it's going to take Putin driving his tanks into Berlin to wake up the Europeans. Let's kick off with Rustin Edwards. Good morning, Rustin. Seeing as you're sitting closest to that neck of the woods, head of fuel oil procurement at Euronav NV. I asked the question yesterday, Rustin. I'll ask it again. It seems maybe more pertinent today than yesterday, 24 hours ago. Is this the beginning of the end of this crisis or the end of the beginning of this crisis?
Well, as I voted yesterday, it's the end of the beginning, because I think everybody still has no clue as to what exactly Putin's real end game is here. I mean, is it full encroachment into Ukraine, taking the entire country under Russian control, installing a puppet government, and then backing out? Is it wider? Is it just Donbass? I mean, and so until those unknowns are known, you can't write off as this the closing chapter of a book. It is the opening chapter. Markets are responding basically on the back of what I would say fairly benign sanctions that were put out yesterday by not only the US, the UK, the EU, but you had Japan and Australia following suit, which is a pretty good alignment of OECD against Russia's activities at the moment. So we'll see how the rest of this pertains. I don't think that energy is on the table just yet, as there is way too much interdependency of the European energy markets to Russia. You've got Russian oil refineries or Russian oil refiners that own refining assets in the EU, which you can't put any curtailment on because the EU needs the products. And you have Gazprom owning a bunch of gas storage in the EU. And then you have the US and their dependency on Russian imports. So it is a bit of a shakeout that energy probably the last thing that gets hit in all this. And that's why crude fell off from 99.50.
Let's go to Maliha Bengali, founder of MB Commodity Corner. Maliha, it would seem the wider financial markets took it in their stride yesterday. A bit of drama, obviously, on the news, but ultimately a pullback. Was all the signaling, all the sort of pronouncements by Biden and the Prime Minister of the UK, Mr. Johnson, over the last few weeks, essentially, you know, they blew the news away weeks ago. And so when it arrived, it really was a nothing burger.
You're absolutely right. I think the market is in a bit of a buy the rumor, sell the fact. What we saw happen yesterday is very interesting. There are three dynamics in the market right now: macro, geopolitics, and micro, the fundamental oil market. And I think the market is losing focus on what's really happening before the Russia-Ukraine episode. We know the demand of the oil market has been strong over the winter. We've seen demand has been very strong on a 4-week average basis. On the geopolitical side, you're absolutely right. Putin has done what he has to, but the UK and EU have not come up with any more strong responses because they can't really afford a war. Having said that, if you look at the trading, we haven't stopped buying gas and oil and aluminum from Russia. The two banks involved have not been sanctioned. So this is a bit of optics in terms of what they can actually put. So as you pointed out, the end game is not really known yet, but taking a step back from geopolitics, let's look at the macro. That's been the big focus over the last 3 months. We're in a point where the central bank has to raise interest rates because inflation is very high. We also have an influence where bond yields have been going towards 2%. We have credit markets that are in distress. So we are the verge of a Fed policy error, and the markets have been sort of weakening into that. Having said that, on the micro side, commodity oil market has been strong, but we know that this is a seasonal game. Very soon, winter is going to end. And as we approach March, the question then resolves, how is the global economic slowdown going to impact oil markets? Because these three factors do influence the markets. It's just about timing. And I think yesterday, the market pretty much pointed that out, that if it wasn't for the Russia war premium of $2 or $3, the market actually is quite weak. The oil stocks were quite weak compared to the oil price. So we think it's more of a buy the rumor, sell the fact, because I don't think it's in anyone's interest to go to an all-out war. And the Russian European entities are not stopping gas and oil trading as such per se.
And certainly nobody's putting any sanctions in front of them, except for, I mean, on the energy side, that Nord Stream 2 will be paused at best, one would say. And that was already the case. So it's kind of like, we'll sanction 3 people and pause something that's already paused. I mean, if you're Putin, you're saying, I'm going all the way to Kiev, it seems to me. Daniel Richards, welcome. Daniel Richards, of course, senior MENA economist at Emirates NBD. I thought your headline was fairly on the money and at the same time somewhat sober in your daily note. Initial sanctions on Russia are limited. A very gentle word. Daniel, your thoughts looking from the Middle East, of course, higher oil prices, big bucks on the fiscal side.
Yeah, so as everyone said, it's pretty limited so far. So it's 3 individuals, a couple of banks, but I think obviously Russia knows a lot more can be done. So you'd hope that that would be some deterrent, even if that much hasn't been done as yet. Obviously, there is the energy side, there is the SWIFT side, so there are still deterrents in hand, but I think that really has to be stressed a bit more. But obviously locally, these higher oil prices are a boon for local economies, but we think that's really going to play out more through not so much by government spending. We anticipate that this ongoing efforts at diversification of economies here will continue, as trying to decouple economies away from these boom and bust oil cycles. So despite these higher oil prices and also ramp up in production that we anticipate to continue online with OPEC Plus's schedule. So that will boost the oil economy. But in terms of the non-oil economy, we don't really expect governments here to really start splashing the cash as they might have done in the past. So what we do expect to see locally is that budget deficits or budget surpluses will be in play and will be greater this year than we've seen for quite some time.
Rustin, I mean, the big question here, we have a few references to it in our daily digest, particularly the head of the Qatar energy minister, head of Qatar Energy, the biggest, one of the biggest LNG producers in the world, saying that Russian gas could not be replaced in Europe in short order. But nonetheless, this event, as dramatic as it is on the political side, is coming at a time when the tightness in the European energy demand is softening a little bit. It's been a fairly mild winter. Storage looks pretty full. It's not a real stress moment in European energy. Sorry, Rustin, you're on mute. Yeah.
The famous phrase of the COVID world, you're on mute.
Yes, that's it. The t-shirts will be issued shortly.
Mother Nature played her part this year, both in Asia and in the US and in Europe, keeping the winter rather mild. We had a couple of cold spats, but mainly it looks like the majority of cold weather actually hit the United States and Russia over the winter period. So, demand had not been as strong, and you've seen that with the fall off in natural gas prices. Now, there is still a premium in the natural gas market because there is concern about supplies going forward. Because as you look at European energy demand, there's a higher demand in the wintertime as people need to have home heating, but there's still a lot of power generation created by natural gas. So that's always going to be a risk that's going to sit in the market until alternative supplies are brought in, or if the U.S. can increase its exports of natural gas, which should happen with shale production ramping up. There could be an offset there, but then you have to get the shipping aligned to those markets. So because there is no pipeline, the logistics of the pipeline make it far easier for the gas to flow from Russia into Europe. But without extra ships on the water moving natural gas, it's going to be a hard thing to overcome.
Maliha, you mentioned obviously on the parallel corridor of all of this, there is inflation and there is the tightening cycle of the Fed. We have the Fed chairman due in front of the Congress this week. a growing sense, at least, although buried in the news, that the sort of monetary policy makers are looking at perhaps a bigger start, maybe a 50 basis points. Where do you think the outlook for that sort of more aggressive tightening, at least from the kickoff, might be? Is it a serious contender at this stage?
So we've established that the Fed has been in a bit of a catch-22 situation. The last few times, right now inflation is about 7.5% year over year. They either have to raise rates aggressively or taper their balance sheet. So we think they can probably do a possible 25 to 50 basis points rate increase. The market's pricing in 25 basis points increases for this year. We don't think that's going to happen because I think the Fed might start its cycle. Eventually, markets may collapse and not be able to handle that, and they'll have to U-turn their policy, pretty much what they've been doing for the last 10 to 15 years. Having said that, the Fed really cannot ease their policy until asset prices fall significant enough to trigger the Fed put. And that's a big debate in the market right now. Where is that Fed put? Is it 4,000 or is it 3,800 or even lower? And the other thing is prices need to come back down. So either demand needs to take prices down so we don't have that much inherent inflation, or asset prices need to collapse. The Fed really is in a bit of a pickle, and they're hoping and waiting that demand sort of comes back down. And maybe that will happen going to Q2 because we are seeing a lot of forward macro indicators where things are easing up. So maybe we may have seen the peak of inflation, but the rate of change could be lower. But it is a bit of a wait and see game. The data has to work in line with the Fed's policy actions. The big question is how the markets take it. We have not seen the balance sheet taper, and yet the markets are already having a bit of a wobble. And I think that's big unknown for Q2.
How could we have reached peak inflation when we've been, above $90 a barrel on oil for the last number of weeks, and it looks like we're holding, and maybe by many, Vitol CEO yesterday expected to go over 100 and hold. I mean, peak inflation might be still ahead of us.
You're absolutely right. In terms of the rate of change, so the rate of change have increased from Jan to Feb to March. We'll see the data coming out in March right now for the Feb data. If you're plateauing or not, I think that'll be a very good indication, but prices have not come down. Oil needs to fall, raw services price, goods, inflation, everything needs to come down. But the question is, how fast does that demand take the prices down, and how strong is demand to go into Q2? But you are right, that's a big concern right now. If you see a print higher than 7.5%, the market will not be happy.
Daniel, the inflation story has somehow not impacted yet in the Middle East. Your thoughts on that and the emerging markets' ability to handle this tightening cycle and this rising price of inflation?
Yeah, so I mean, it's varied across the MENA region. Obviously, inflation here has been super low, deflationary for some time, and it is picking up. But even so, we expect it to peak at around 2.5% here, which is markedly less, or a third less than what we're seeing in the US, and around half of what we're seeing in Europe. So not quite the same story. A number of factors, obviously house prices and rental prices are going up, but oftentimes that comes further down the line. And as other of those energy price increases pass through, then they will offset each other. So there's a number of different things going on, but obviously we do expect a much more aggressive move by the Fed in terms of tightening. We do now anticipate 50 basis points in March, and then 25 points sequentially up until September, potentially one more November or December, taking 2% by the end of the year. And obviously that does have implications for global markets, and especially some of those regional economies reliant on those portfolio inflows. Egypt, for example, which has done very well at attractive that portfolio, that foreign ownership of local debt over recent years. So certainly something to watch out for the time being. There are positives to the Egypt story, but that is certainly going to be a challenge there, and to other countries, other emerging markets around the world, certainly.
In terms of fiscal coffers, obviously the balanced budgets this year, if not surplus. Daniel, what's your thoughts on where the regional government, Saudi Arabia in particular, will use this windfall of income? Will they start spending big time?
No, we don't anticipate the kind of spending you might have seen when previous windfalls have come in. So we've upgraded our headline growth forecasts and our budget forecast. We haven't particularly upgraded our non-oil growth forecasts for UAE and Saudi Arabia because we don't really anticipate that splurge in cash to come through. We think they're going to, some of that investment will come through PIF, but largely we think they're going to try and, as I said earlier, try and decouple the growth cycle from the boom and bust in oil prices that we've previously seen, trying ongoing efforts for this diversification. But we're seeing not just in terms of budget spending, but in terms of taxes coming in, a new corporate tax locally, and Bahrain doubling its VAT. So ongoing efforts within the region to really try and move away from being directed by oil prices in terms of local growth.
Rustin, of course, that price inflation challenge, the idea that it might be peaking, as Malia was indicating, or the outlook for the second half of the year backing away, a lot of analysis is on that, and the Fed may be even betting on that. But nonetheless, your thoughts, where is the supply chain congestion? We're even seeing now shipping fuel costs rising. There's still a lot of upward pressure on prices through the supply chain and the shipping.
And unfortunately, I don't see that changing anytime soon. As I mentioned before, the accordion impact of the supply chains of the container ship market are now starting to feel the impacts of COVID restrictions in China. Hong Kong being a major export port for China finished goods and import port for raw materials, experiencing 21-day delays now. They've backed out from, they're still in the full COVID lockdown mentality in China, which as Omicron is starting to I don't know if it's even peaked yet. It's growing at a rapid case rate in China and other provinces within China. It's going to continue to put pressure on the supply chain from the supply side, which is then going to impact the delivery side again. So you might see a bit of let's say a drop down in the delays going into the United States, but give it 8-9 weeks from now, there's going to be another supply crunch that's going to hit going into the summer. And then that's going to recycle again as the supply chains react to the ebb and flow of delays in the load port or the discharge port. Fuel costs, as long as crude remains moving up, fuel cost goes higher. That gets rolled into the finished goods because that's a price that gets passed on to the consumer. And voila, inflation, I think, is here to stay, and it's well embedded.
Malia, at that point, we have today the basically nearly hospital beds queuing up outside the doors of Hong Kong's hospitals, overflowing, as images that we saw in the early days of COVID in northern Italy and such places. Really quite amazing in a city as advanced as Hong Kong. And the same day, we've got Boris Johnson lifting all COVID protocols in the UK. Which of these two stories should we look at for a market direction? Is it glass half full or glass half empty? I mean, is Hong Kong a cuckoo in the coal mine for China?
You're absolutely right. I think now the whole COVID response has become very political indeed. It's way beyond my paycheck to actually comment on that. But we know the Western governments are looking to open up economies and go back to life as normal because Omicron has been a very sort of mild version of COVID to speak. China and the rest of the world, we know that policy is a lot more controlling. Obviously, the zero policy is highly impossible, but that's something that they want to do right now. But that has demand implications for commodity demand, oil demand, and even oil-related demand that we're talking about. It's very hard to say, but I think in this part of the world, in Europe, we're seeing things easing for no more travel restrictions, no more PCR testing. So I think there will be sort of a bipolar reaction in the markets. It's be very political and very region specific. But we are monitoring demand because that's very, very important in terms of oil demand specifically. We have for the implication into going into March and April. And our bias is that obviously the demand should weaken, that the recovery on the travel side from Asia will probably be delayed versus here it's picking up. So we're looking at sort of different scenarios as to how that would play out from oil perspective.
Daniel, they say history doesn't repeat itself, it rhymes. Yesterday, we had the news that Iraq made its final payment to Kuwait for the invasion of 30 years ago. Some multiple $50+ billion over many, many years. Last payment made yesterday, the day that Russia invades the Ukraine. Looking regionally in terms of the obviously symbolicness of that payment, but also the idea of where does regional intra-trade go in the Middle East? Always been a laggard compared to global standards. Are we seeing anything indicating there that that's going to improve and what that might mean for energy consumption in the region?
Yeah, I think obviously when you have some big regional economies whose primary export is the dollar-priced oil, then that's going to be the case. That is going to hold back inter-regional trade. It's also going to hold back, in some cases, domestic manufacturing, for instance. So that will continue to be an impediment to inter-regional trade. But I think there's ongoing efforts at boosting that, and some regional economies are doing better at amplifying the non-oil private sectors, and hopefully that should then lead on to greater trade between these economies. But for the time being, obviously, it's much lower than you might anticipate for countries that are so close to each other. They're simply not producing what each other want, I think, currently.
And does that have to change, not to detract a little bit from our main narrative, but does that have to change in order for these regional economies to reach their sort of big target 2030 ambitions, Saudi Vision 2030, etc., that intra-regional trade is a critical pillar in that? They all seem to be still very much focused on global rather than regional.
Yeah, I mean, obviously that would be a massive boost, especially when you look at some of the bigger population countries in the region. But it's not just the economics there. Sometimes there are political considerations as well that might hold that back. Obviously, Iran has a very large population and a big market base. But I think as these relations continue seemingly to improve presently, then hopefully some of that can start to lead into greater economic ties, or even vice versa. Sometimes the economics will take the forefront, and the improved relations will follow.
Well, it certainly seems that is more of a priority at the moment, although many things can get derailed. Let's get the survey question out and see where the view of the room is here. Do you think the initial reaction of the West to Russia's invasion of Ukraine will encourage or discourage Putin to go all the way to Kiev and have a cappuccino? Will the reaction encourage the muted, or as Emirates NBD said, limited reaction, encourage or discourage Putin to go all the way? Rustin, we talked a little bit in our earlier commentary about the supply chain block-up. Where are we in the sort of regular check-in to California, China, in terms of shipping logjams and clearing those backlogs? Still a lot of expectation that can be achieved.
Well, as I said earlier, I mean, China is starting to build on a backlog of ships to load because of the COVID control. So you're starting to see this buildup of ships waiting for cargo operations to happen, because not only is it, it's delays at the port due to manpower constraints as COVID lockdowns happen, and then also getting the finished goods from the factory into the port to load onto the ship. So you do have this delay building up in China. Hong Kong experiencing 20-day delays, 21-day delays in getting ships in. That's rolling up to the coast as well. So you're going to see that build happen in China over the next couple of weeks. On the U.S. side of the market, it is starting to cool down a bit. In Los Angeles and Long Beach, the California state appropriated some acreage for putting more containers onto the ground. So at least they have more places to store boxes, because for the time being, boxes have been stored on the streets because there were no place to put it, which that in itself causes safety and other hazards. You're driving down the boulevard and you see a row of containers sitting there, which could topple in the next earthquake. So at least they've done stuff to alleviate the congestion in the California side of the chain now. So now it's just a factor of getting ships back in, moving stuff across the pond. But again, I think that as we start going into the summer months in the United States, they're going to feel the pinch again of supply chain constraints and empty shelves.
Maliha, when we look at the sort of growing, one would have to anticipate, I would think, that the initial muted reaction from the West in terms of sanctions are going to escalate. Because my view, personally, I don't think anything's stopping Putin myself. But so you would expect these sanctions are going to have to ramp up. I'm just wondering, from your perspective, if indeed they do, and the hesitancy perhaps to do so is that it is a bit of an own goal. At what point do sanctions, to really punish Russia, if you like, to really make it a punishment, does that end up being an own goal on Western economies and markets?
I think the sanctions on Russia have been ongoing since 2014 going forward. We've seen how much they've really impacted the market. In my humble opinion, I don't think Putin has any more aspirations other than just the Eastern Bloc, because it's all about black. It's all about supply chain, port access. He's very happy in sort of controlling that. I don't think it's in his interest to go and take over Kiev and go to Ukraine, but we do not know. Obviously, that's just speculation on my part. But having said that, if things remain status quo, we expect this thing is going to die down, because end of the day, more and more sanctions we don't think will change much for Russia. Russia has been planning for this for quite some time. And as you said, business in terms of gas, energy, aluminum, nickel, this is a big part of Russia's exports to the rest of the world. So that's not going to impact the markets. I think this is much more geopolitical noise. It's speculation on our part, but we don't think that's in the interest of anyone to escalate this and create a massive scale. They probably put more sanctions on much more elite members. But other than that, we don't see much more happening. There's not much they can do.
Daniel, your thoughts in that regard, and for the Middle East region, is this, without it being, being sort of facetious about it, a kind of a win for the Middle East, at least for now, ultimately higher oil revenues without too much consequence for the region?
Yeah, obviously you can paint it in that way of those prices that, a lot of the moves have been on speculation so far rather than actual market fundamentals, but certainly the region is going to benefit it because they are boosting production while prices are going up. And that is a major windfall for these local economies after, years of falling short in many ways. So obviously, yeah, in that way, yeah, it's pretty good for them.
Not that one wants to get wins in this particular way, but nonetheless, the negative potential as well. I mean, Dubai in many ways has been able to be in the right place at the right time on a number of occasions. Let's get the survey result to give Rustin the last word this morning and see where we're at. Initial reaction seems to be a very large encouragement by at least the views in this room. Rustin, your own thoughts, and sitting in Europe, what does this feel like? I mean, it's always hard from a distance to see, is this a hot edge story? I'm sure if you're sitting in Kiev this morning, you're really very nervous. If you're in Estonia, Lithuania, Latvia, very uncomfortable. But deeper into Western Europe, does this feel like a crisis of scale that we're hearing from Boris Johnson?
I think the crisis is a fairly large scale. When you think of, if this turns into a more full-on scale hot war, because, okay, throwing shells across at each other, if that truly is going on or not, is a hot war for those people living in the region. And we hope for all their safety and everybody can, find a place to get out if they can get out, so the civilian casualties would minimize. I think that's the biggest thing that's going to happen. But I think once you think of, if Russian tanks move across the line of control towards Kiev, you're going to see a massive influx of refugees out of Ukraine into Europe, and that's going to cause its own humanitarian issues. Fortunately, if Putin is being nice and not coming in the middle of winter, at least he's coming in towards the spring, so weather won't be a big factor for the refugees if they do come across the borders, which everybody's anticipating. But it is going to be a humanitarian crisis on a massive scale. And I think that is what Europe is actually girding for. I think, the short-term impacts of energy, whatever, okay, that's going to hit. The inflationary impact, that's going to be massive. But I think, for the most part, Europe can absorb that gut punch. But the humanitarian issues, those are going to be massive. And I think that is the big underlying issue that is going to be present, if Putin decides to move forward. Unfortunately. Well,
that is where we'll leave it. The unknown, ultimately, all moving in one direction, however, no surprise. I mean, you don't put 150, 200,000 troops surround a country and then, surprise, I'm moving in. No real surprise there. Where it goes, I mean, listening to Putin's speech the other day, ultimately, he very categorically declared that Ukraine was not a country. And if 1 and 1 is 2, I think one has to pay attention. He does, he's pretty clear about his intentions, I think. Thank you, Malia. Great to have your words and insights. Rustin, as always. Daniel, thank you so much. Really appreciate it. Catch every morning, 10:30 UAE time. Have a great day, everybody. All the best.